One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. My name is Alex Mason and I am your host. This is the show dedicated to helping you get better at both the technical and non-technical aspects of investment banking. You're going through the recruiting process. You're trying to figure out what all these terms mean, how they relate together. You want to be prepared for your interviews. And guess what? That's why I'm here. I'm an incoming MBA student entering this fall. And I'm just trying to learn all of these things. And in the process, as I learn them, I'm breaking them down for you so that we can learn together. And today we're starting a brand new topic in this podcast. We're going to be talking about valuation. And valuation is so key for the profession of investment banking. You can imagine mergers and acquisitions. How do you know how much a company is worth? That's super important because if you're trying to help a client do a certain type of transaction, it ultimately is based on what the worth of that company is, both the company that's acquiring another business and the target company, and just super important. And so we're going to be working through both these concepts as well as some examples. But first, we need to talk about what are the three major valuation methodologies, and what are the, not just what are they, but what are the differences between them? What are the nuances? How can we think about them? That's what we're going to be talking about today. So let's go ahead and break this down right now. There are three main valuation methodologies for valuing a business. Number one, comparable companies. Number two, precedent transactions. And number three, discounted cash flow analysis. Those are the three major valuation methodologies: comparable companies, precedent transactions, and discounted cash flow analysis. So first of all, comparable companies. Now, just like the name sounds, what you're doing with this valuation methodology is comparing the characteristics of other companies to the one you're focused on for the deal. For example, if you're working on a deal where a company is trying to merge, for example, with Keurig Dr. Pepper, which is the beverage giant, you might look at Coca-Cola and Pepsi Company in order to figure out what the similarities and differences are. And you would look, of course, at the financial characteristics, but you might look at other attributes of the companies, such as geographies, where they operate, the size of the business, and so forth. And this will help you inform what you present to the clients. So that's comparable companies. Next, you have precedent transactions. With this type of valuation methodology, you're looking at deals that have closed in the past in order to inform how you approach the current deal. Now, sticking with the beverage examples, for example, if Coca-Cola recently merged with another business, you can look at the terms of that deal and see what applies to your current deal in the beverage space. Now, for example, what was the financial value of the transaction? Was it in the millions? Was it in the billions? How much? Was it paid for in cash or stock or a combination? Now, this is called consideration. And then you might ask, what is the EV to EBITDA multiple that was paid? And we talked a little bit about multiples recently. So these are some general questions that you would ask for precedent transactions. With precedent transactions, we're looking at deals that have actually happened. With comparable companies, we're looking at the attributes of similar companies, whether or not deals have actually happened. And so, of course, these can produce different results for different reasons. Now, in general, this precedent transactions method is going to produce the highest value for a company. Now, why is this? It's because of the concepts called the control premium. And what that basically means is that businesses are generally willing to pay more for other businesses if they get to control it instead of if they only hold a minority stake. So imagine you and I are negotiating a deal for a business, and I own 49% of the business and you own 51%. Well, you're going to have the ultimate say over what goes down because you own the majority stake. It's very similar to companies that are negotiating. A company is going to be willing to pay more for 100% of a business than, say, just only 20% because they control everything. And the amount extra that they pay for the business is called the control premium. So that's why you'll typically see precedent transactions be a little bit higher. And I think there's some debate as to what the rule of thumb is, but I did hear a teacher say the rule of thumb is somewhere around a 30% control premium for businesses. So this third methodology of valuation is a very, very important one, and one as a banker, you're going to need to know this one inside and out for sure. In fact, I've already been asked interview questions around this concept in real interviews, and it is discounted cash flow analysis. So instead of looking at comparable companies or closed transactions, with this method, you're focused on the fundamental financial performance of the business itself, with many assumptions that get projected out into the future. You are looking at the intrinsic value of the business. That's a term that you need to know, intrinsic value. So on the buy side of the financial industry, so companies like hedge funds, institutional investors, etc., this is a foundational method that's used to value businesses for the purpose of investment. Investors want to know how much cash flow a business is going to be producing in the future, and that ultimately helps dictate its value. Now, some things about DCFs, which is the abbreviation for discounted cash flow, that you're going to need to know are that you would not use a DCF if the cash flows of a business are relatively unstable. So, for example, you could think about a young biotech company that's pouring tons of money into research and development. They have little to no revenue, but potentially huge cash flows later. That's going to take a very different type of modeling than your standard discounted cash flow method because the cash flows are not consistent and they may be relatively non-existent for some time. And then also a caveat is with banks and financial institutions. You wouldn't use your typical DCF for banks and financial institutions because they use debt differently than other businesses do. And so they're just not as appropriate. Now, the good thing about DCFs is that they actually use the fundamental cash flows and assumptions based on historical cash flows to value a business, which can be super valuable when compared to something like a precedent transactions or comparable companies analysis. You're not just kind of pegging to what other people are doing necessarily. You're looking at what is this business actually producing, and that's why it can be so valuable. Now, another caveat with DCF analysis is that you can get a really wide range of results as far as what the intrinsic value of the business is, that is the valuation, depending on the assumptions in the model. And it's all about assumptions. So for example, what kind of interest rates are you assuming in the market? What's the cost of capital for this business? Is it being viewed as a risky business from the perspective of investors or being viewed as a relatively safe quality business from the perspective of investors? How about revenue projections? Are you expecting low revenue growth, high revenue growth? What are we looking at here? And things like profit margins, et cetera. All these things must be assumed in order to get to a number of your actual cash flows. And we're going to go in depth into the question, walk me through a DCF, because that's a super important question you're going to need to know. But for now, just understand that discounted cash flow analysis is a major valuation methodology, and it's different from precedent transactions and comparable companies. So with that, those are the three major valuation methodologies and a little bit of nuances about the differences between the three of them. So remember, we have comparable companies, precedent transactions, and discounted cash flow analysis. That's what I got for you today. My name is Alex Mason, and you're listening to Investment Banking Insights. Next time, we're going to be talking about some other less common valuation methodologies, but still important ones that you need to know. I'll see you next time.